In 1950, he wrote a paper called Computing Machinery and Intelligence. And he also proposed the idea of the Turing test at that time. That test is at a high level. It's a human sits down with a computer chat interface, not dissimilar than what we see today, and starts two discussions. One's with a human, one's with a software application. And to pass the test, the software application has to fool the judge into not being able to pick out which one's actually the human and which one's the computer.
Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Let's launch into it then. As we always do, we'll start with A, B, and C at the end of the 20-page memo. And C is oil demand and supply. I was a bit shocked earlier today to read in Platts that Iran, if you look here, I have Iran in 25 being 2.6 rather than 3. Through August, they're at a rate of 3.2. So despite sanctions, Iran's producing more oil this year, which will be, more supply, or that 3.3 down at the bottom of surplus capacity. Some of that surplus capacity is being produced. The price of oil there is a supply-demand price, and then there's a risk premium. And the risk premium can range from $5 a barrel to $20 a barrel. The risk premium is because of the macro risks to production in places like the Middle East. And I think the risk premium now is a bit on the high side because despite Trump and Putin's meeting in Alaska, there apparently is not too much chance that some type of settlement can be reached between Ukraine and Russia. So that means we, the U.S., and hopefully the Europeans, for sure the Europeans, will put in heavier sanctions on Russian production. Russian production in 25 here is at 9.3 million barrels, down from 10 last year. For 25, about 4 of that is exported as crude. Some part of it is used within Russia. I think only about 3.7 is used in Russia. So the rest is exported as products, mostly to Europe. The Europeans have not put any sanctions on using Russian oil. It's mostly exported as diesel and jet fuel. Those sanctions, I imagine, will go on to the extent that there's no cooperation trying to make a deal with Ukraine. And we've already put sanctions on on India, which takes half of the 4 million barrels of export crude. China takes the other half. We have raised the tariff, the secondary tariff, as they call it, on India to 50%, up from 25%, because they will not cooperate in using less Russian oil. Theoretically, we should put the same penalty on China, but we have other negotiations going on with China. So any move by the Chinese or against the Chinese for taking Russian oil is off in the future somewhere. The price of oil, the other thing that happened is the Khomeini, the religious leader of Iran, finally did a public outing. And he said that he would not sanction any direct negotiations with the U.S. on nuclear or any other issues. You'd expect to see more sanctions on Russia. Now, how do the sanctions work, or how have they worked in the past? What the U.S. did, especially during the first Trump administration with Iran, is they went and made deals with India and China, who are taking the Iranian crude, to not take Iranian crude. And the pretext typically is that the Iranian crude, for that matter, Russian crude, is transported on ships that are not in class. In class typically means that it's been dry docked within the last 3 or 4 years and inspected, the thickness of the steel plates and stuff. There's a whole bunch of tankers that are not in class. They're delivering, oftentimes called the shadow fleet, delivering Russian crude, delivering Iranian crude that are not in class. So if China decides, because of some kind of a deal with the U.S., to use less Iranian crude, they can simply have their port managers say, we're not going to take any more ships not in class. Now, India's made a definite decision to not cooperate this time on Russian crude. I don't know whether they would cooperate on Iranian crude, but the U.S. Treasury has enormous capability because most contracts for oil, like 95% of the contracts, are settled in dollars. All those dollars are settled through a system called SWIFT, which the U.S. government runs. SWIFT is a payment system. So the Treasury Department has several experts who have staffs that track these payments. So whether it's, they can tell you what ship the oil came in on, how much money changed hands, and the U.S., there's no reason why the U.S. can't go to work on reducing Iran production and reducing Russian exports of oil and products. That all can happen. And I think given how intransigent the Iranians are and how intransigent Putin is, that will happen. Now, the impact on the price of oil, if we go to Exhibit B at the bottom, these are prices from last Thursday, but they're not too much different now. The near month was 63. The 26 price was 62. The average price last year was around 74. I updated over the weekend the EOG page. Those companies which are primarily producing oil, this is page 11, are all had lower cash flow this year. EOG and Magnolia, to their credit, have increased production, but the capital spending is flat. The capital spending in these companies will go down as the cash flow goes down. To track that back to Exhibit C, U.S. production was kind of peaked in 24 at 13.3. It will be less this year. There's no question that lower capital spending by U.S. companies will mean lower oil production. So if the price of oil stays in the 62, 63 range, say about $10 less than last year, there will be less U.S. production. I think in time, in the OPEC countries and also non-OPEC, in addition to the U.S., there will be some decline in production. And in fact, the production estimated here for 25 is only up 400,000 barrels from 24, and 24 was up 1,400,000 barrels, and 23 was up 1,000,003. So this problem of surplus capacity will get solved. If Russia continues to be intransigent and Iran continues to be intransigent, it'll get solved without the price of oil going to a much lower number. I mean, in the past, when Saudis decided to give up restraining production and, as they say, go for market share, which they are doing now. I mean, the OPEC, the 2 million barrels of curtailed OPEC production is history. As of September, they kind of restored it all. Now, Saudi Arabia has another 1 million barrels a day of voluntary on top of that. They're going to start restoring that. But as long as that risk premium holds oil in the $60 and it's a full $10 less than last year, I think the surplus oil production gets settled. Now, if somehow Putin decides to collaborate with the U.S. in trying to do some kind of a settlement in Iran, that will cause that risk premium to go down. If the Iranians decided they wanted to collaborate with the U.S. and get sanctions lifted, the price will go down. But right at the present time, none of that seems too likely. I don't want to take too much time because we want to get on with the software history, but U.S. government revenues and expenses, every week that goes by or every news cycle that goes by, to me, this estimated 26 forecast for spending and revenues shows a significant decline in the deficit from $1.9 trillion in the fiscal year that ends at the end of September to $1.5 trillion. Now, $1.5 trillion is still at least $500 billion too much, but it is progress. And the debt held by the public, in other words, the treasury debt that's not held by the social security system or whatnot, if it would just level out at 102, if you go all the way back to 28 or 29, it was like an 80% range. But COVID caused it to increase dramatically. And even after COVID, the Biden administration just kept spending. Look at the all other category. It was $910 billion. This is everything other than defense and interest and Social Security and whatnot. All other, and was $910 billion in 2019, the year before COVID, and it went to almost $3 trillion. And as the Biden administration came out of it, it went down. It went down to a 9 and then $1.3 trillion and $1.4 trillion. What has to happen? You have to get another $200 billion out of that. And that's more or less the work of Doge. Even Musk has completely fallen out of favor with Trump and the people around it. That was what Doge was up to. Defense, they've allocated more money, but I don't think they're going to spend it. So I think that'll hang at $900 billion. There is additional revenue from tariffs built into these numbers. Is like about another $300 billion from tariffs, and the GNP grows, so that helps. There's lots of publicity on Medicaid, and Mike and Jason have talked about impact on healthcare. First of all, Medicare and Social Security just go up. I mean, those are programmed, but Medicaid has been flat as a board. This is a federal commitment to the Medicaid program, basically to help finance Obamacare. And it's been flat as a board at $600 billion. So I'm getting more comfortable with the idea that our deficit spending can be managed. With that, see whether Mike or Jason have anything to add, and then we can spring into software history.
Oh, on the tariff revenue front, Bessnet made a statement saying that we'll be at a $500 million tariff run rate by the end of the year and sees it going to over $1 trillion. I don't know if that's bombastic or not, but that would put a pretty big dent in this deficit number.
Yeah, I think $1 trillion is fanciful. Normally, he's careful, and I don't think talking about $1 trillion of tariff revenue is. I mean, think of it. 15% of our economy. Our economy is something north of 30 trillion. 15% of our company is like $4.5 billion. I mean, $1 trillion would be 25% across the board on everything. I just don't think anything like that number is feasible. But it is having an impact, and it will have an impact. And as long as the GNP grows in real terms, well, GNP, there are two growth characteristics of GNP. There's real growth, which is what we're interested in, like 2% real growth, which means everyone's getting wealthier. And then there's inflation. The Fed is focused on getting inflation down to 2%. And they use this PCE thing that they like because it boils out energy pricing and food pricing. Getting that to 2% is almost, with or without impact, one-time impact from tariffs, that's going to be next to impossible. But on the other hand, our economy is slowing down enough, and we're starting to see much lower job creation. I just got to believe this Federal Reserve and the next Federal Reserve, once Powell is replaced next May, is going to take the Fed funds rate from 4 to 4.25 down. I would think by this time next year it'd be 3 to 3.25. The problem is that the 10-year rate is what an awful lot of the economy is built on, and the 10-year rate is having a tendency to kind of go up as short rates come down. Why is that? Well, that's the weight of that having to finance that $1.5 trillion of deficit every year. The other thing is that the Fed Reserve balance sheet is still too high. Mike and Jason, you probably have a more specific number. My memory is it's still around $7.5 trillion. Well, before they started doing quantitative easing, to try to get out of the malaise that happened after the Great Recession in 08 and 09, I think the Fed balance sheet was around $2.5 trillion. So, do we really need a Fed balance sheet that's $5 trillion bigger than it was before they started with quantitative easing? Probably not. Think of the impact on interest rates if if you had a Fed, which I guess is not likely to happen, but if they started saying, look, we've got to get the balance sheet back to, at least halfway back to where it was before we embarked on quantitative easing, you've got to raise $1.5 trillion new money. Let's say you have to make up for the Fed because the Fed doesn't sell bonds, it just lets them run off. In other words, it doesn't reinvest the interest and the amortization. And so if they had to finance $1.5 trillion, which is an optimistic number, plus $1 trillion of runoff of the Fed balance sheet, even if you have 3% Fed funds rate, are you really going to have a 10-year bond that isn't, 4.5 or 4.75, about where it is now? And I think Mike and I talk about this a fair amount. I know Mike and Jason talk about it between them. I don't think either one of you disagrees with that scenario where 10-year rates stay close to 5% and the policy rate of the Fed funds rate gets down to 3%. I mean, it's very difficult to predict interest rates. I mean, it's like trying to predict weather 3 weeks from now, but I think that's a reasonable expectation. I think both of you agree.
Yep, I think so.
Yeah.
I mean, we can expect that short end of the curve to come down. There's a lot of incentive to get it down. We have a lot of debt to refinance, and getting it down even just 1 point at the short end will make a marketable impact on the federal government's ability to refinance its debt. So the question is, does that spark some inflation? And we'll get the PCE numbers on Friday, I believe. So I don't know. We'll see.
I know Jason's more conservative than either one of us, so he's keeping his counsel here. But
I kind of think the Fed shouldn't lower the rates in the near term. I guess I am more concerned about the inflation, where we haven't seen any impact of the tariffs having inflation yet. But the tick up in inflation that we've seen is in the services sector. So that is more indicative of like some systemic inflation. And I think the jobs data is better than the headline numbers say, since we were rolling off a lot of government jobs in the private sector, then was making up that difference on top of the positive headline number. So I think the jobs market isn't as bad.
Yeah, we've blown through 20 minutes, so we apologize, but there's not going to be any page 1, 2, 3 or any healthcare. I think we just have to spring into software to finish out the 30 minutes. So over to you guys. I'll try not to interrupt so we get through as much as we can.
Got it. So where we ended last week was pretty up to date on traditional cloud computing. So that is the non-AI software services that power mobile apps, SaaS applications, and serve content like this recording on Spotify and YouTube. But that leaves us with AI. Kind of starting over the history for AI, it goes back to the 1950s, a lot longer than most people suspect, and back to Alan Turing, who we discussed earlier. In 1950, he wrote a paper called Computing Machinery and Intelligence, and that proposed the initial concept of machines capable of thinking, and he also proposed the idea of the Turing test at that time. So that test is, at a high level, it's a human sits down with a computer chat interface, not dissimilar than what we see today. and starts two discussions. One's with a human, one's with a software application. And to pass the test, the software application has to fool the judge into not being able to pick out which one's actually the human and which one's the computer. So it's kind of safe to say that language models today have passed the Turing test. He wasn't the only researcher at the time thinking about this. There was many papers published on this topic in the 50s. So a lot of people were discussing what they eventually became to call artificial intelligence. They discussed neural networks and how they can model the brain with binary systems, since they were kind of newly invented the binary computer.
That's one of the things I think is most fascinating, is that like it was 1946 or something like that. It was the first kind of research on neural networks occurred. So, everybody, sometimes it feels like these things happen overnight. It's been,
80 years?
Yeah, 80 years in the making.
Yeah. Yeah, and there were other topics too. They theorized about different games to test intelligence of computers. They settled on chess, actually, as being the best judge of software intelligence. And they also discussed the first ideas of abstracting language into mappings of logic circuits. So a lot of the ideas that we're building today were originally conceptualized in the 40s and 50s.
And there was like an AI boom in the 50s and 60s, right?
There was, but it was, due to the capabilities, the technology they had at the time, the AI boom through the 50s, 60s, and 70s was rules-based systems. So they programmed a lot of complex logic, but it was really, if you see this, do this. And eventually they became expert systems. So you had highly programmed logic systems that had a narrow function, but they were programmed by human experts to kind of take into account all the aspects of whatever narrow task they specialized in.
Yeah, like broadly, the idea was that you could like take an executive or an expert in some field and like program their brain into a computer and then query that computer for the things that you want to know. Those systems were like notoriously fragile. And I don't know of any that were actually successful implementations.
No, and eventually that style of programming fell out of favor. And by the 1990s, we've decided on there's moving to a concept more of where the software applications learn from the data rather than everything being explicitly programmed into the application. So that's what we really started calling machine learning. These algorithms were developed heavily on mathematical principles. And this was also the time, it wasn't until the 90s that these original ideas for neural networks started to actually be programmed, and largely due to having the programming languages and the compute power that they needed. But still, even at this time, you could only make a pretty tiny neural network before the computation overwhelmed the CPUs. So also in the 90s, this was 1997, IBM released their Deep Blue system. If everyone remembers that, it was a chess system. It beat chess champion Garry Kasparov. So that application was kind of a combination of the ideas of the time. A lot of expert rules. It did have probabilistic modeling, and then it used brute force simulation. So that was, again, the compute finally caught up to where you could simulate a lot of chess moves forward past the state of the board at the time and kind of pick the best path. So then by the early 2000s, we had more mainstream machine learning algorithms. We talked about Google's PageRank being one of them. Another class of algorithm that was data-driven from internet collected data was recommender systems. Maybe the most famous one of those was Amazon's product recommender. It was key to them gaining adoption of the Amazon platform and convincing customers to purchase different types of products from online that they weren't at the time, since e-commerce was a pretty new thing at the time. And then that kind of leads us up to a big change that occurred in 2012. So at the time, there was a competition, an annual competition called ImageNet. It was an image classification competition. So you would show a software algorithm a picture of a house or a car or a dog, and it would have to correctly identify what was in the picture. Each year, the teams would bring new software applications, and they would improve on the previous generation by 1% or 2% in accuracy. In 2012, a team of researchers from the University of Toronto led by Jeffrey Hinton, released. They brought their algorithm that ran a neural network on 2 NVIDIA GPUs, and it beat the second place team by 11%. So it was an enormous jump in capability at the time. And
well, in previous ImageNet competitions, like people were getting like 0.1% better than the previous year, really small amounts. I mean, this like completely changed the AI approach.
Yeah, to the point that every team started competing with a GPU-powered neural network from then on. And that really was kind of the rebirth of AI. So from that point forward, GPUs dominated AI computation, and it was really the time where compute and data and all the pieces kind of lined up to make these neural networks function.
I think that's probably the most important point about AI is that in the first hype cycle of AI, you had the idea of models that could work, but you did not have the compute and you did not have the large amount of data that you needed. And it wasn't until really GPUs came to be. And the reason is to train these models, you do these massively parallel calculations. They say embarrassingly parallel. And GPUs just happen to be very good at this. And if you look at kind of the history of NVIDIA and Jensen Huang, he at least claims to have had this vision that GPUs and parallel compute would be more useful in the future than people believed it would be. I don't think he could have imagined that it became as useful as it was. But when they decided to invest in the programmability of their GPUs, that opened up the ability to take a gaming GPU and run a software algorithm on it. And here we are a decade and a couple of years later.
Yeah. And then the last real innovation was in 2017. Google released their transformer model paper that was a new form of neural network design that ultimately came to underpin all of the language models that we're using today. So I guess to tie a bow on it, the way I look at it is kind of an arc of how we process data. And I'll start with cloud computing. When we had that initial concept in the early 2000s, we started collecting a lot of internet scale, really large data. And in those days, you were really looking at data mining tools. So there's a data mining tool called MapReduce. That's what you'd say, program to go find data insights that you thought might exist in your data already. You knew what you're looking for, and you were mining huge amounts of data. The next evolution was these machine learning algorithms. You would start learning from the traffic patterns of your data. So if you were looking at like website traffic or a lot of stored text, you would develop patterns in that, and then you could do anomaly detection or analyze user behaviors and find strange behaviors in text saved and produced by users, and kind of draw insights from that. So that was more of looking at how your data is being processed in real time. And then, that it ends where we are today with these modern forms of AI and language models and generative AI. And we have much more data being trained at a much larger scale on these very sophisticated algorithms that are essentially looking at word patterns. And ultimately, under the hood, these are statistical models that are choosing the best patterns of words based on what you've put in previously. So it's just smart enough that we perceive it as intelligence. And I think it's kind of interesting that the original name for the Turing test was the imitation game. And way back in the 50s, he even envisioned that this was just computers kind of simulating human behaviors and patterns.
So
that's where we are today.
To put a bow on your bow, so thinking forward to what's the next kind of phase of all of this AI stuff, I think it is the tie of the deterministic programming, which is kind of the historical programming, and this new probabilistic programming. And I think part of it, in order to see the real benefit, is we're going to have to figure out when to use deterministic programming and when to use probabilistic programming. And I think we're at the very early stages of figuring that out. So I'm sure more of our future discussions will encompass that.
And both will be important.
Yeah. I think we've completed software history with updates coming.
That's right.
Yeah, and one thing, a few people have requested this, so I think I'm going to finally do it, is we'll patch all of the software history segments into one episode, and we'll also patch all the chip history segments into one episode, and we'll publish those. So keep an eye out for that in the podcast feed.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hi everyone, it's Allie again. After a super eventful summer, I'm finally back here for a video at Oak Cliff Base in Oyster Bay. This past summer, I've been able to race on the 12-meter Courageous for Tiedemann Classics in New York Yacht Club, and then went over to race Bayview Mackinac Race and Chicago Mackinac Race. And I came back and did a little bit more 12-meter racing at the Edgartown 12-meter regatta, following up with the Hershoff regatta this past weekend. We have a huge influx of new sailors coming in this week to race on the Curve 50 for our Vineyard race launching out of Stanford Yacht Club. So please make sure to stay in tune for that coming up this Friday. We'll be posting and updating on our social media pages, on our Facebook and Instagram page, and are still looking for more people to come out to join our high performance racing, which will have our fall foiling series coached by our high performance coach B. Lindsay the first weekend of every month starting in September. So please make sure to check out racingcalendar.org and oakcliffsailing.org for new updates about upcoming regattas. Thank you.
And now back to the show.
Right. Just with a couple minutes left, obviously we have NVIDIA reporting after the market close. So that's the dominant thing at page 1, 2, and 3. But anything on healthcare, Jason?
The only thing, I don't think I mentioned it last week, but it was revealed that Berkshire's next big investment was United Health Group. I guess all I can say is I hope Berkshire's investment model changes and they become activist investors.
Right. Yeah, large investors have to disclose their positions, and I think United Healthcare got low enough, so Berkshire and some other well-known investors showed up acquiring the United Healthcare stock. Problem Jason has with it is he really doesn't like and doesn't trust and whatever else negative he could think, the PBM model. And I don't know what the pharmacy benefit model part of their EBITDA or free cash flow, but it's significant. And I think what's happening is the pharmaceutical companies are under a huge amount of pressure to do most favored nation pricing, which means why is the drug costing me more in the U.S. than it costs in Europe or Canada? And one of the things that I'm looking for some confirmation from Jason, but the pharmaceutical companies are going to start going direct, not through the PBMs, in order to try to hang on to more of their margin. If I get that right, Jason? Or
absolutely, yeah. A lot of them are starting to sell direct, and the number that they quote is gross to net, and usually the PBM is taking half of their sale price back as rebates. So they can sell the drug at half price and retain their margin.
Just in closing, Trump administration, we talked about their being frustrated with getting Ukraine and Russia to cease hostilities and getting Iran to, give up sanctions or give up being sanctioned and try to move 80 million people into a much better economy and much better quality of life and whatnot. But if you look at healthcare, and there'll be plenty of people who are listening to the podcast who'll disagree, but I think led by Jason, but with Mike and I agreeing, we really think the Trump administration is doing a pretty good job in healthcare. And with that, maybe a closing comment, Jason, on your review of that stance.
Yeah, I think the changes at the FDA by and large have been positive. And then I guess my big thing is if we make everyone healthier through the food supply, not to sound like RFK Jr., but if everyone is eating healthier, you generally live a healthier life and you demand less healthcare services. So I think we're at a positive inflection point in the U.S.
Yep. Let's spend our money on something other than healthcare.
Healthcare rather than sick care.
Yeah.
Yeah.
Now, the most interesting part of healthcare, I think, is biotech. And Mike and Jason, we're going to put them to the test here, having done a great history of chip making and great history of software. Maybe we can try start next week or the week after a history of biotech to build on this taking 10 minutes every 30 to go into the history of something. So in the meantime, everyone be well and stay healthy, and we'll be here exactly 7 days from now.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.